All right, let's get right into it. If you hear the name Unity software and your brain immediately jumps to, oh, they're just a game engine, well, you are operating on a massive misconception. Now, look, that description might have been completely true a decade ago, but today, it completely misses the incredibly complex hybrid investment thesis we're exploring in today's explainer. Unity isn't just selling a basic editor or a rendering stock anymore. No, they're actively trying to be the definitive end-to-end platform where game studios create, ship, operate, and, crucially, monetize their products. It's the whole shebang.
So here's our roadmap for today's analysis. First, we'll look at why Unity is way more than a game engine. Second, we'll compare their create versus grow solutions. Third, we're decoding their recent financial reset. Fourth, we'll look at the actual drivers of intrinsic value. And finally, we'll cover the risks and the road ahead.
Okay, let's jump into part one, more than a game engine.
To really grasp what Wall Street is trying to value here, you have to look at the sheer scale of Unity's digital footprint. 70%, that is the share of the top 1,000 mobile games globally built using Unity. That is huge. But their dominance doesn't just stop at mobile. We're looking at over 1.3 million monthly active users operating the Unity editor. We're looking at least 28% of the top 1,000 PC games on Steam. And perhaps most staggering of all, Unity ads combined with ironSource ads serve more than 68 billion impressions every single month. Literally, Unity is deeply, structurally embedded in the global mobile and gaming stock.
Because of that immense scale, Unity is actually best understood as a hybrid platform. Basically, it's a game development and monetization ecosystem where creation and growth absolutely must reinforce each other. The idea is simple. They want the engine adoption to capture the customer early on, and then they use the monetization tools to capture the ongoing economic success of the game. It's a brilliant loop. But this dual identity is exactly why the company is so easily misunderstood by traditional analysts. They try to force Unity into a single software category, and it just doesn't fit.
Moving right along to part two, create versus grow solutions. Now, to see how the economics of this really work, we literally have to break the company right down the middle into its two fundamental halves. Think of it as two very different operating cultures living under the exact same roof. On one side, you have Create Solutions. This is your classic developer software driven by subscriptions, deep workflow lock-ins, stability, and traditional SaaS economics. But on the other side, you have Grow Solutions. This is ad tech. It's a high-octane world driven by monetization, ad yield, and intense market cyclicality. It's kind of like a bunch of meticulous game developers sharing a cafeteria with aggressive ad tech salespeople. A wild mix, right?
And when you look at the 2025 revenue breakdown, a really stark financial reality emerges. The Create segment, the famous game engine everybody talks about, brought in roughly $621 million. But the Grow ad tech segment, over $1.2 billion. Let that sink in for a second. Despite its universal reputation as an engine vendor, Unity actually makes far more money helping developers sell ads than it does helping them build games.
If we peel back the layers inside that massive Grow segment, there's a really crucial internal shift going on. By late 2025, the Unity ad network, which is powered by their new AI model called Unity Vector, surged to represent 56% of total Grow revenue. Meanwhile, their legacy ironSource ad network dropped way down to 11%. What this highlights is how quickly Unity Vector has become the workhorse. It's driving over half of their monetization power now, proving they are aggressively innovating rather than just coasting on older acquisitions. Which forces us to deliberately pause and ask the core strategic debate surrounding the stock. Does this collision of software and ad tech cultures actually deepen their economic moat? Or is it slowly pulling the company apart? I mean, in theory, an end-to-end platform is a beautiful, self-sustaining flywheel. But in practice, managing a hyper-stable software subscription business right next to a highly cyclical, performance-driven ad network can get structurally messy really fast.
All right, let's get into part three, decoding the financial reset.
To see if Unity can actually survive this high-wire balancing act, we have to trace their incredibly turbulent recent history. Late 2022 brought the ambitious ironSource merger. Okay, makes sense. But then, by 2023, they triggered the infamous runtime fee crisis. This was an absolute masterclass in how to instantly alienate your entire user base and severely damage developer trust. Seriously, the backlash was intense. Enter Matt Bromberg in May 2024. As the new CEO, he came in and initiated a highly disciplined strategic reset, cutting the workforce by roughly 25% and winding down a bunch of non-strategic businesses. And finally, By 2025, that highly radioactive runtime fee was officially canceled, putting customers safely back on a predictable subscription model. So, what did all of that turbulence actually do to the numbers? Well, if you just glance at the headlines, Unity's statements are super easy to misread. Just look at the massive spread for 2025. They reported a GAAP net loss of over $400 million. Ouch. But their adjusted EBITDA was nearly $409 million, and they generated nearly $404 million in free cash flow. What this essentially tells us is that beneath all those surface-level accounting losses, the underlying platform economics and actual cash generation are honestly quite strong.
You're probably wondering, why the massive GAAP distortion then? Well, it's driven heavily by the staggering figure right here, over $380 million in stock-based compensation. Yep. And on top of that, Unity faced nearly $419 million in intangible asset amortization, which included a massive write-down related to their past What a Digital acquisition. So while cash flow is genuinely improving, these ghosts of acquisitions past and those hefty compensation structures are still acting like a heavy anchor on the official income statement. Which brings us to part 4, drivers of intrinsic value. If Wall Street wants to value this intrinsic recovery properly, looking past all that top-line noise, they have to underwrite 3 very specific metrics. First up, Unity 6 adoption. This is their ultimate product proof point. It has to demonstrate rock-solid stability and performance to defend the create side of the business. Second is vector performance. Since the growth segment is where the real money actually is, Unity Vector must continuously prove it can deliver superior ad yield and ROI. And third, trust restoration. Look, canceling that disastrous fee was a great first step, but proving true pricing predictability for game studios is an absolute ongoing economic necessity.
And finally, part 5, risks and the road ahead.
Now that we know what needs to go right, we impartially have to look at the very real threats that could derail this whole post-reset momentum. First off, PR damage to workflow lock-in takes a really long time to heal. Developers simply do not easily forget pricing scares. Second, there is fierce, genuine competition out there. You've got Unreal Engine dominating the AAA level, and the open-source Godot engine is rapidly winning over indie developers. Third, ad market cyclicality is always going to pressure the growth segment. And finally, that ongoing acquisition hangover and shareholder dilution from stock-based comp, those remain very real structural burdens for the company.
Yet, despite all of those massive challenges, the recent strategic reset under Matt Bromberg basically stripped away the non-core distractions. We're talking about those expensive side bets on film and industry digital twins, to reveal one single crystal clear mandate: be excellent at helping game studios build and monetize. That's it. It's all about proving that a narrower, highly focused Unity can actually be worth far more than a bloated, distracted one. Which leaves us with a final provocative thought to ponder today. Can Unity finally synthesize its two halves? Can they actually turn this massive creator base into a deeply trusted, fully integrated platform? Or are they destined to remain a structurally messy hybrid, forever caught between stable software subscriptions and hyper-volatile ad tech cycles? Honestly, whether they pull this off or not makes Unity one of the most fascinating fundamental turnaround stories in tech today. You'll definitely want to watch their next earnings closely to see exactly which way the pendulum swings.